Next up, we have Ferlyn Tan, Senior Equity Analyst, Stocks and ETFs Research, IFA Singapore. She will be covering global financials, the city that never sleeps. Ferlyn, please.
All right, hi, good afternoon everyone. So I'm Ferlyn and today I'll be sharing with you guys one of our top ideas for this year, and it is none other than the global financials. So despite the run-up over the past few months, we still think that the global financial sector is an attractive space to be in, given how stars are aligning from both the top-down and the bottom-up perspective. So before we continue, perhaps let's first try to establish what exactly makes up the financial sector. So we all know that financial sector, it plays a very important role in any economy. And if you just look around you, you will realize that almost everyone has established at least one relationship with at least one financial institution. And almost all businesses, regardless of what industry you are in, they will require financial services at some point in time, be it for loans, insurance, or just simple financial transactions. And based on the JICS classification, we have broken down this sector into three different categories. First, we have the banks, we have the insurance companies, and we also have the other diversified financials. So for the banking industry, I'm sure everyone is very familiar with it. It simply refers to the financial intermediaries that connect savers and borrowers. So a few notable examples would be our three local banks, DBS, UOB, and OCBC, as well as some international banks like JP Morgan, and ICBC. Next, we also have the insurance companies. Insurance companies are the ones that offer risk management products to their customers and collect premiums from them in return. Some examples would be like Great Eastern, Prudential, as well as AIA. And finally, we also have the other diversified financial. It generally refers to a range of companies that offer a wide variety of financial products and services. So sometimes you can think of the other diversified financials as companies that do not belong under the banks or the insurance. So a few examples would be the asset management company, fund management company, brokerages, or wealth management platforms like FSM1 IFAS. So looking ahead into 2021 and beyond, we see 5 key catalysts that will drive the global financials earnings and share price. So first is the full resumption of capital distribution programs across the banks. Second is the fall in loan loss provisions. Third is an earlier than expected rate hike. Fourth is a recovery in insurance premium. And finally, number 5 is a healthy growth in global AUM within the wealth management space. So first, we have the full resumption of capital distribution programs. So over the past 1 year, due to the sudden outbreak of the coronavirus, regulators across the globe had to take several actions to ensure that the banks within their jurisdiction conserve sufficient cash to weather through this economic downturn. So what most of them did was that they asked the banks to reduce their dividends and or to stop share buybacks, whereas in some other regions like Europe and UK, the regulators urged the banks to cancel all dividends and stop all share buybacks till at least 2021 this year. By this point, I think it's worth sharing that most of the banks actually continued to maintain very healthy capital ratios during the peak of the coronavirus last year, which suggests that the banks have the capacity to maintain their payout if the regulators did not step in. But of course, the regulators decided to be prudent about it and went ahead with cancelling the dividends, the capital distribution programs. But fast forward to today, regulators have started to lift these capital distribution bans, but unfortunately, most of them are still inclined towards longer dividend and share buybacks ban. So which means to say, most of the banks have were allowed to pay out some dividends, but it's only a fraction of what they could have paid pre-COVID levels. But on the brighter side of things, we believe that this is just a matter of time before regulators will allow banks to resume their payouts. And given the fact that how capital distribution programs have become such an important factor for bank investors over the years, we believe that the full resumption of capital distribution programs will be a major share price catalyst for this sector. Next, we also see the easing loan loss provisions as a driver that will help to support the earnings across the global banks. So last year, most banks across the world, they had to set aside huge amounts of reserves as they prepare themselves for a wave of bad debt arising from the pandemic. And unsurprisingly, loan loss provisions became the main culprit that dragged down the bank's earnings. But the thing about loan loss provisions is that they are usually more forward-looking. So most of the banks have already front-loaded the credit allowances in the first half of 2020. And according to most of the larger banks' management, loan loss provisions is expected to slow down this year before returning to normal levels in 2022. So in other words, this should signal a turning point for the banks, which will help to support the valuations of the global banks. And moving on to rate hikes. So late last year, the Fed, they stepped up and mentioned that they will probably not conduct any rate hikes until at least 2023, or until at least the economy shows sustained economic recovery. So using the Fed fund rate as a benchmark, we expect to see flattish net interest margins this year. And on top of that, we also do not expect to see any substantial compression in the bank's net interest margins given how interest rates are already at an all-time low. However, over the past few weeks, we have noticed that inflation has started picking up rather rapidly, and we also expect to see inflation to continue picking up throughout the rest of this year. So with rising inflation expectations painted as a backdrop, rate hikes may get pulled forward. And in fact, some market participants have already started pricing in rate hikes as early as early 2022. So we all know that for financial institutions, most of their profits are dependent on net interest income, which is correlated to the interest rate environment. So therefore, an earlier than expected rate hike will be a major catalyst for the global financial sector from a profitability perspective. And moving on to the fourth point, we also see a recovery in insurance premium that will help to support the earnings of the insurance industry. So needless to say, the COVID-19 outbreak last year has hindered most insurance sales. And this is because interaction between agents and clients was severely limited by social distancing measures. And number two, non-life insurance segment was also badly hit given how consumer spending fell to an all-time low during the lockdown period. However, as more economies start to open up their economy, we believe that this should signal a turning point in terms of insurance premium from both the life and non-life perspective. So first of all, the COVID-19 outbreak has brought about a huge awareness of health insurance, and more consumers are now more receptive towards the idea of insurance as they begin to understand the importance of having adequate protection against illnesses, against hospitalization and death. So we believe that this shift in mentality, the shift in mindset will help to support life insurance premium moving forward. At the same time, we also expect to see a recovery in the non-life insurance segment given how demand for property, cars and travel is expected to recover after crashing in 2020. So when that happens, naturally, the demand for property, auto and travel insurance should pick up as well. So all in all, we expect global insurance premiums to recover in 2021 this year after contracting last year, and China will be the one leading this rebound. And last but not least, we also have the wealth management industry. So this industry has always been a bright spot within the global financial space. And in fact, last year, global AUM continued to register very strong growth despite COVID-19, which clearly says that even COVID-19 is able to hinder such strong growth trajectory. So the asset management industry is set for another decade of growth, and we believe this will be driven by the increasing wealth of the high net worth individuals and the mass affluent. So these wealthy investors are constantly looking for more avenues to park and grow their assets, be it in more investment-oriented products like ETFs or mutual funds, or more protection-oriented products like long-term health insurance. But either way, this will drive strong growth in financial assets, which will translate to higher revenue and earnings for the asset and wealth management industry, given how most of the companies in this industry earn based on a small percentage of the assets under their management. So to sum up, we continue to see several strong tailwinds that will propel the global financial sectors forward. So we also expect investor sentiments to improve given the prospects of a full resumption in capital distribution programs across the banks, as well as an earlier than expected rate hikes. So our fair PB of 1.3 times translates to an upside potential of more than 15%. And not only that, the global financial sector is also offering an average dividend yield of 3.2% per annum in the next 2 to 3 years. And to gain exposure to this sector, our recommended ETF is the Ishares Global Financials ETF with the ticker code IXG. So from the chart on the right, you can see that banks and insurance makes up most of the net assets of this ETF, which is also why we have chosen to focus more on these two industries in our presentation today. So this ETF was also chosen based on our in-house ETF selection methodology, which my colleague Hui Shi has shared earlier this morning. So this ETF has one of the best liquidity and tracking difference. It also has a very decent expense ratio of 0.46%, making it our preferred ETF. So to sum up, this is one of our top ideas for this year. So we think that it is a great time for investors to jump into this sector. But let's say if you're an investor who is unsure of when to enter the market or unsure of how to start your investment journey, perhaps you can consider engaging in our RSP program where you can deploy a fixed sum of money into this ETF on a monthly basis. And that's all I have for you today. Thank you so much for tuning in. And if you have any questions, feel free to type it down in the Q&A box and we will try to address as many of them as possible. Thank you.